Will investing in the HDFC Life Sanchay Plus plan offer good value in your portfolio in the long run or not? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So this is a non-linked savings endowment insurance plan. Some of the key features of the policy are it offers 4 different policy benefit options to choose from. They are guaranteed maturity option, guaranteed income option, lifelong income option and long-term income option. This policy requires a minimum premium installment payment of 30,000 rupees a year, and it also offers rider options for accidental disability and critical illness plus. These features look attractive, especially the guaranteed maturity and income benefit options in particular. So of course the benefit is guaranteed, but you must look into how much is guaranteed. So this policy is marketed as a savings insurance plan and hence must offer a return rate on maturity. And if you want to know more about its benefits and features, you can definitely look into the policy brochure for reference. So here we are going to look into the review of the maturity options. So to calculate the IRR of this policy, which is the internal rate of return, we are going to take an example of a healthy male of 30 years purchasing this policy in the lifelong immediate income plan. So the policy term comes around 50 years and he pays an annual premium of 1 lakh plus taxes per annum throughout the premium paying term, and when he survives the policy and once the policy matures, he will get a maturity benefit. So we will take this example and consider what the maturity benefit would be for different options. Like if he has opted for guaranteed maturity option, then his maturity benefit would be 22,27,460 rupees, which should be paid as a lump sum at maturity. But suppose if he has opted for guaranteed income option, then he would have gotten a guaranteed income of 2,02,750 rupees per annum from his 14th year of the policy term to 25th year. So the payout period will be for 12 years. And if he had opted for long-term income option, then he would have gotten a guaranteed income of 87,000 rupees per annum from 12th year to 36th year. So the payout period here is 25 years, plus he would also have gotten 10 lakhs at the end of the payout period, which is the 36th year. And if he had opted for a lifelong income option, then he would have gotten a guaranteed income of 80,250 rupees per annum from 12th year to 99 years, which is 38 years of payout plus 10 lakhs at the end of his payout period. Now let us review the IRR of each policy option. So first, in the guaranteed maturity benefit option, you can see the IRR comes around 5.23%. So if you think it is not bad, keep in mind that you have to pay the GST in addition to the premium you are paying. So if we consider that also, the return rate will be even lesser than 5.2%. So this is not a wise option at all. Now next we have guaranteed income option. Here the IRR comes around 5.18%. So if you think it's fair enough to consider buying this policy plan, remember we did not include the GST which you will be paying along with the payment of the annual insurance premium. So if you weigh that in, the IRR must be only a little over 5%. In addition, your benefit will be the same throughout the payout period as inflation increases during the payout period. So today's 2,02,750 rupees will not have the same value after 10 years in the payout period. Therefore, this option is also not an advantage. Next, we have guaranteed lifelong income option. The return on this policy is shy of 5.39%. So the IRR is 5.39%. But think about it, a maximum of 5.39% interest return, which is the IRR for a period of almost 50 years is ridiculous. As we have seen In the above options, you are going to pay more as GST, and inflation will keep reducing the value of your income exponentially. So it may appear good in contrast with the previous options, but from a money smart investor's perspective, it is also a big leg down. The last option, which is the guaranteed long term income option, claims to have some flexibility. So let's review that also. So here the IRR comes around 5.49%. Even a minimum assumption of just 5.50% inflation will reduce your 5 lakh by 4.3 times. Overall, this guaranteed long-term income option is capable of providing only 5.50% at the most. So at this IRR for a period of 30 years should not even be an option to consider. And the obvious, you will be paying the GST for your premium payment, so reducing the return rate even more. So I must say all these benefit option is also the same thing in a different wrapper. Do these options have anything at all to offer an investor? Let's review the disadvantages. Beware if your financial advisor recommends you this plan. It's because they may get 30 to 40% as commission. For example, if your premium is 1 lakh, your advisor may get 30,000 to 40,000 as commission out of your premium. A bank relationship manager may also try selling you this product. This is because the bank also gets a commission to do so. Relationship managers also have pressure to sell these kinds of products and meet targets. Hence, there is also a lot of mis-selling happening. The mis-selling is that these products give around 8 to 9% return. So before you buy the product, verify the truth on the HDFC Life website as to what the actual returns are. So this policy has a potential disadvantage of high agent commissions paid to their brokers and banks. Many think that as the product looks complicated, it must be a good plan. But it is not the case. PPF, mutual funds and term insurance though are old, simple and boring and have no marketing gimmicks. They are easy to understand, also fulfill their purpose. See here, complexity kills transparency, but less transparency in the other options I just told you makes it easier to mis-sell. So avoid complicated investment products like HDFC Life Sanchay Plus Plan. Because if you look at it, how much returns are guaranteed? The returns are guaranteed only if you stay the course. So the policy benefits will reduce if you surrender the policy or even miss premium payment. They portray it as guaranteed and lifelong. But how much is guaranteed? See what is your final returns. Only 5 to 6% which is guaranteed. And you will also have to pay the GST on the premium. After that, the returns will become even lower. If you're looking for wealth creation, this is not the right product, because even compared to this, PPF would give you higher returns, which gives you guaranteed returns, as it is also a government backed product and it has low risk factor. For example, if you compare to mutual funds, the longer you invest there, the more power of compounding you will experience. For example, if you invest 1 lakh in mutual fund for the duration of 10 years, that means you would have invested 10 lakhs in 10 years. Your returns will become greater than 19 lakhs with a modest interest rate of 12% in mutual funds, and you can even withdraw the amount in the 11th year if you need, and you can also withdraw anytime actually in mutual funds. So if you want to invest for 20 years, for example, if you are investing 20 lakhs, your returns will become 80 lakhs, which is approximately 4 times your initial investment with a 12% interest rate. But as you saw in this policy, its returns is even lesser than 6% after the 20-year policy long term. So there are obvious advantages to investing in mutual funds as compared to HDFC Life Sanchay Plus Plan. So we have now just saw a returns on investment. The next advantage is a lock-in period. Mutual funds do not have any lock-in period. So if you want to cancel your investment like SIPs in the first year, there will be an exit load charge of 1%. After 1 year, there will be no charge, so you can cancel your scheme anytime. But in this policy, it requires you to pay all your annual premiums on time for 10 years in the first variant and so on. Otherwise, you will not receive the benefits of this policy. So you're locked in for 10 years for paying your premiums. There is a free look period of 15 days, but even if you cancel within 15 days, you will be charged fees and tax towards stamp duty, medical examination, and proportionate risk premium. Now, which is more goal focused? Mutual funds or HDFC Life Sanchay Plus? Mutual funds allows you to list your short term like 2 to 5 year goal and long term 7+ years goals and invest accordingly in the right scheme where you will be benefited from higher returns as compared to any other policy including HDFC Life. So HDFC Life Sanchay Plus plan is designed to keep you in your comfort zone towards the expectations of future income security. Truth is, you're only receiving the amount that you have given them over a period of 10 years or so. All the added benefits get automatically led by the inflation rate. Therefore, there is absolutely no point in achieving any major or minor financial goal with HDFC Life Sanchay plan. The next advantage is the regulatory authority. Mutual funds are regulated by a reputed agency called SEBI, whereas HDFC policy is regulated by IRDAI, which regulates insurance policies. SEBI ensures greater security and safeguards against all frauds in mutual funds or stock investments, whereas SEBI has no such role to play in such income schemes by HDFC Life or other such companies. The regulation of IRDAI, in the other hand, is predominantly focused on insurance regulation and not on investment regulation. So SEBI's regulation is well evolved in regulating investments, protecting investors' interests, and proactively taking measures to stop mis-selling. So if you are an investor investing your money for the long term, your first priority is to achieve higher returns. Therefore, it is advisable that you should invest in SEBI regulated platforms such as mutual funds or stock markets. We hope this information helps you choose whether if you have any queries until this point. If you have any queries, you can ask them in the comment section. So what is the final verdict? Is investing in this policy worth or not? The term guaranteed ultimately seems to be only a marketing plan than a policy plan. A return of 5 to 6% in these policy options can never be an investor's delight but misery. Such returns can't even beat inflation for a long duration of 20+ years. Instead, you can buy term insurance for life cover at a much lesser price while you invest the rest of the premium in instruments that give better returns. But still, why do insurance agents try to sell you this policy? Like many policies in the bazaar, they get a high agent commission by selling this to you. PPF is also a triple tax exempt investment instrument that give returns above 8% quarterly. So if you're willing to manage risk, there are even better options in the market. So you can invest in equity mutual funds for even higher returns, an average of 12% return. Be money smart and stay away from such low return savings insurance plan.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.